Okay, so thanks much to everybody for showing up here tonight. We're going to cover several things. I have some administrative items. I'm going to try and keep it to a minimum. One of the things that I was originally going to just spend a slide on, and it just kind of grew, is a whole area dealing with how you can balance a portfolio with max Sharpe and Sharpe parity, and we'll get into that. And then the rest of the night basically gets turned over to John, where he'll be talking about the topics there, cognitive bias in the VIX, and then correlation and diverse asset portfolios. And if by some strange shot we have 15 minutes left over, I'll actually cover the rot blood screen. Okay, that's been in holding now for about 4 months. Going back in time, this is the legal disclaimer. This is for educational purposes. Don't invest your money this way. I'm not a professional money manager, i.e. I don't know what I'm doing, etc., etc., etc. All right, so getting right to it. Administrative items. We've already covered the next couple of meetings. Upcoming events, there's several. Okay, I put new batteries in this, really I did. But it's always good to turn the on switch on. The first one is this Saturday, Introduction to Estate Planning. Lawyer from up in San Francisco. She'll be talking about estate planning, all that kind of good stuff. The most famous recent incident I can think of is with dealing with the LA Clippers. Okay, that got sold, right? The guy had a girlfriend and his wife took it away from him and all that. That was because the trustee agreement wasn't signed properly, and she was able to prove him incompetent. Believe it or not, that's how the LA Clippers got sold. So it's interesting. In any case, that's Saturday. You can sign up for this at Eventbrite. The next two meetings, CTAG and Sector Surfer Users Group, we're going to have a slide on that next, so I'll kind of skip over that. You can also have a slide on the Silicon Valley Options Group. That's this Thursday. VectorVest. I do not know of any local meetings. They had a couple in August, and I don't know what they're doing going forward. All right, so the next thing deals with September 17th, which should be, a week from Wednesday. Scott Judds and Jim Gamache, I don't know if that's pronounced correct, will be down here at Holders Country Inn talking about a whole number of good things. Since we've got Sector Surfer Joe, I'll turn it over to you. Joe, you got anything you want to say?
Well, thank you, Al. I'm real pleased that both Scott and Jim have agreed to come down. They're working on several new things, and they want to share it here first. So as you see, there are 4 items there in particular. He said he's willing to entertain questions, after each subject. And also, I don't know if you saw the new September perspective. They're opening up the Sector Surfer University now. So that's a new area. If you haven't seen the perspective, it is on my website, investorshelp.net, and just go to Sector Surfer Perspective. This information is located under Sector Surfer Meetings. So I'm really looking forward to this. The membership continues to grow through Scott's efforts. So please mark your calendars. Next Wednesday, try to come around the 6 o'clock so we can order dinners and so forth. Kick it off from 6:30 till 8 on Sector Surfer, and then the Computerized Technical Analysis Group will begin from 8 until 9. Thank you. Thanks, Al.
All right. Next one. All right. The Silicon Valley Options Group. Now, I don't usually attend this meeting because I'm not that much into options, okay? But this week, I think they're doing something a little different. They're having Richard Friesen, and he's basically going to be talking about the psychology of trading, okay? Now, obviously, I think it's going to be oriented toward options and so on. However, it probably, if you're into that, okay, and into trading, and or have some of the classic problems about analysis paralysis, for example. Analyze to death, but you can't really hit the enter key to buy something or sell something. This might be a very interesting talk. So I'm going to go there, time permitting, simply because it's on a completely different topic, right? It's on basically trader psychology more than anything else. Larry, you're a member of this, right? Did I hit the high points? Anything else you want to mention? Okay. So a little bit different. Next up, user presentations. I'm always looking for somebody to stand up here other than me to give some presentations. There's a long list of items here, including the rot blood screen, which I'm guarantee we'll do it in 2015 for sure. And sharp parity is at least one version of it is on the queue for tonight. So if anybody has anything they want to talk about and show, please contact me. I'm always willing to fit people in. Doesn't have to be a long or fancy presentation, so don't be inhibited by that. Next up, excuse me. I think most of you are repeat attenders, but basically we do everything off of the Yahoo group. If you don't have the Yahoo addresses and so on, here they are. I've also got a business card I can hand out and give you that. We also post all the files in Dropbox. Tonight's presentation, for those of you who have laptops or whatever, is already at Dropbox, okay? Under the imaginatively named SIMI 1409 meeting folder, okay? Next up, since the last meeting, August was kind of slow. I'm going to talk about some market health indicators next. And these two items, essentially have some description and slides. From the last meeting, we talked about the Financial Crisis Observatory, and there was a reference that the Swiss professor that runs that or whatever had a presentation on TED. Well, I went out and I took a look at it, and you can look at that email, that posting, and that will point you to the TED presentation. You can also just look up Financial Crisis Observatory at TED. It's pretty simple. So it's it's not that long as I remember. I think it's about 20 minutes, and he gives a pretty good talk. And then I made it, for those of you interested, the normal September, end of August monthly portfolio updates. Okay, so it was either last month or the month before where we had a discussion about some recession indicators. In particular, one of the ones I use deals with, that comes straight out of FRED, or the Federal Reserve database. And there was some feedback that basically said, doesn't get updated a lot, doesn't give a lot of warning, therefore you could be late if that's what you use, okay? So another indicator that's actually turns out to be quite reasonable in some ways at least, deals with unemployment insurance claims and whether they're trending down or up. So basically, the blue line here, and this starts 1967 over here to effectively today, that blue line is the 4-week moving average of initial unemployment claims. So this is the thing that you always hear about every Friday, basically. Oh, we had 200,000 people on unemployment, new unemployment claims, or 100,000 or what have you. What this chart shows, and this all comes from Doug Short's website, is effectively if you normalize that for essentially the working age population of the workforce, okay, that gives you some idea, and plot it, this is what you get. And the relationship is, and it sort of makes sense, okay, is, well, geez, as the economy is on a bull cycle or a growth cycle, typically unemployment claims go down, and then before the next recession by X months starts to go back up, and then you have a recession, okay? And so this has been true for 50 odd years, 40 to 50 odd years. And the next slide will show you the numbers, so to speak. And so you can use, to some degree, the fact that unemployment is now no longer dipping and starting to turn up as an indicator or warning that, things may not be going that well. Now, be forewarned. This because it turns up doesn't mean that it's going to happen, i.e. you can get false signals. Example, if you take a look at 1990 to 2000, great bull run, right? Okay, well, it was heading down most of the time, but there were times, like here in 1995, where it started to head back up again, for whatever reason. You probably had a lull in the economy or what have you. So this is not, oh my God, it's going up, therefore, I've got to sell my stocks and get into cash or whatever. But it does give you an early warning indicator of what might be going on. Yes? No, workforce participation does not factor into it. I believe the denominator is the number of total employed. Okay, so you can see that the regression line here is going down over time. And there's a number of reasons for that. Okay, it basically comes down to perhaps in some ways we're doing a better job of the people that are looking for a job are getting jobs. That's one way to read that. The other way is what you just said. What is the percentage of population that isn't even looking for a job anymore? Okay, man, your second comment on that is everybody talks about how bad the workforce participation numbers have rolled over. They went from roughly 68, 69% to, I'm going to say 65. Okay, big deal, right? There are plenty of studies out there that half of that is nothing more than demographics, i.e. the baby boomers getting old and retiring from the workforce. There's other stuff going on, but at least half of it is just demographics. In any case, this is, if you will, the theory in the chart. This is what I actually posted. Here's the initial claims. Here's every recession since '69. The average turns out to be 12. There was one case when it was 3, and that's when the Fed under Volcker forced a recession by, I don't know, I think he set the interest rate at 18%, if I remember right, something like that. And so basically, if you eliminate that, it ranges from at least 7 months notice to up to 22 months. And the 22 months was the one just before 2007 crash, okay, or the most recent recession. One of the other interesting things is the fact that, and you can kind of see this in the chart to some extent, it's also an excellent predictor of when you're coming out of a recession, okay? So it basically tells you fairly quickly that, yeah, the recession's over. And it's fairly accurate to within 0 to 2 months type range, okay? So for example, in the most recent recession, this, I think, predicted was out in May of 2009, and that was right around the same time that I think that they ended up saying that, that was the end of the quote-unquote the recession. So, okay, so that's just another indicator. There's a third one, but I'll get to that maybe next month if anybody looks at it. You can just use the Conference Board's leading economic indicators, and it does a pretty good job too, as well. Okay, so I just wanted to speak to that since that was an item last time. Market health indicators. Duh, boring. Long. Okay. You're above the 10-month, storm guard's on, NASDAQ new high, new low, a breadth indicator's on, trailing 60-day volatility on the SPY is 0.53%. The TED spread for credit crunch is minuscule. The initial unemployment claims, this is the lowest it's been in this cycle. Okay, so we're at least 7 months away from anything bad happening. And the Fred recession warning, you worry about it at 10% and we're at 0.3%. So basically, full